We have a ton of catalysts this week that will move markets higher or perhaps lower. In this video, I will go over these catalysts and my expectation for markets. And I'm actually kind of bullish for this week, believe it or not. And let's start with some of your Fed speakers, which I do think the main goal of these Fed speeches this week will really be to bring down 10-year treasury yields, something the Fed's 50 basis point rate cut did not do. It actually sent 10-year treasury yields higher, which did tighten monetary policy. So first and foremost, let's go through the economic calendar. These are going to be your events that can move our markets. And there's a lot of Fed speakers, as there usually is, following an FOMC meeting, because the 2 weeks or so before the meeting, you are in what's called a blackout period, something Jerome Powell talked about on the podium just last week. So starting off Monday, you have Fed Bostic that will be speaking at 8 o'clock in the morning. 8:30 in the morning, you will get the Chicago Fed National Activity Index. This is Eastern Standard Time, by the way. And then you have S&P Global Composite PMI, Manufacturing PMI, and Services PMI. This actually can move the markets, especially if you see a big move higher or lower. You are looking for the composite PMI to fall about 1.6 points down to 53. Manufacturing to actually rise about a half a point to 48.5. And you have services PMIs that are expected to fall a little bit from 55.7 down to 55.2. And then later on in the afternoon at about 1 p.m. Eastern Standard Time, you have Fed Kashkari that will be speaking. Tuesday morning, you will get the S&P Case-Shiller home price month over month and year over year, and CB Consumer Confidence that comes out at 10 o'clock in the morning, expecting that will actually pick up quite a bit from a 102.9 to 104. So if that happens, that would be good. You want to see people with more confidence. You will get Richmond Fed Manufacturing, Shipments, and Services Revenues Index also at 10 o'clock in the morning. On Wednesday at 10 o'clock in the morning, you will get new home sales for August. You want to see this start to pick up as well, because when people sell their homes, as long as they're equity positive, then they're going to take more money into their bank account, sometimes a lot of money, and that is one area that could be an upside surprise to the economy if home sales do start to pick up. We're not seeing that in mortgage applications. We're just not seeing that yet. But if it starts to actually happen, that would be very positive for the economy. And that is pretty much it for your Wednesday. Wednesday is going to be a slower day. Thursday is when things really start to pick up. So 8:30 in the morning, you have durable goods orders month over month. Now, last month you came in at 9.9%. You are expecting negative 2.8%. Considering last month was that strong, negative 2.8% is not bad. Now, we will see these numbers will get revised. So if it comes down to like 5% for last month, then you're probably going to be positive, right, for the August data, okay? So it depends on the revisions, but if this last month's number stays the same at 9.9%, then generally speaking, the worse this number is that we get, the worse for the markets, okay? If this comes in at like negative 5%, the markets are going to say, oh, that was kind of disappointing because last month was really good and now, well, this month is really bad. But if it comes in line with expectations, that's actually not too bad. So that could be a major catalyst for this week. And really anything that has to do with the consumer, judging the consumer and how they're spending money is going to be important, because the consumer spending money is over 70% of our economy. People need to continue to spend money. If people slow down spending money even a little bit as a collective, that becomes a big problem. So durable goods orders month over month is going to be the first big catalyst for our markets. Now, the PMIs, they can definitely move things as well. But durable goods orders is the first like 1 to 2%, swing catalyst we could have that could cause markets to go higher or go lower in a big way. We will also get the GDP growth rate quarter over quarter final numbers for Q2. You're actually expecting 3% here. The last update we had was 1.4%. So pretty lofty expectations for quarter over quarter GDP. That sounds too high to me, but the higher we come in, the better. You will also get initial jobless claims, which is obviously going to be important. The initial jobless claims last week moved us more than Powell cutting rates at 0.5%, because it kind of solidified maybe the labor market is not weakening too much. We were expecting last week like 230,000 claims, and it came in at 219,000. For this upcoming week, we're expecting 226,000. So a number higher than that, not good. Number lower than that, good news. Now on Thursday, you will get Fed Collins, Fed Kugler, and Jerome Powell, as well as Fed Williams, that will all be speaking around 9:10 to 9:30 in the morning on Thursday. Now Jerome Powell is going to be most important, but I do think, generally speaking, they're going to sound pretty bullish, right? I don't think they're being honest with you right now in what they're seeing in the economy. Hence, they cut rates 50 basis points. There's obviously a problem. But they are, going to sound very bullish. So I'm sure that's going to help markets. Now, at 10 o'clock in the morning on Thursday, you will get pending home sales month over month and year over year. And that is an important number that we want to see start to tick upwards. You will also get Fed Kashkari again at 1 p.m., a 7-year bond auction, and the Fed's balance sheet at 4:30 p.m. On Friday, you have another couple of big catalysts. You have core PCE month over month expecting 0.2%. What Fed Waller said on Friday was that you could actually see core PCE come in at 0.14%, which would actually get rounded down to 0.1%. So if that happens, Wall Street's definitely going to like that. But Fed Waller actually said that the issue is inflation might start coming in too low, like excluding shelter or assuming shelter runs at 2%, then you could actually be under 1% core PCE, and that's a problem. So definitely want to look for that. Personal income month over month expected at 0.4%. Last month you came in at 0.3%. So that's good, right? You want to see wages start to outpace inflation, and preferably by a lot, because we have a lot of catching up to do. And eventually, when wages do catch up to the cost of living, that's when I think people will feel more comfortable spending more money again. Now, personal spending month over month, last month came in at 0.5%. We are expecting 0.3%. So that would be a slight slowdown, but still not a terrible number. If that comes in low, Wall Street's going to hate that. Stocks are going to sell off. If that number comes in high, Wall Street's going to love that, and stocks are probably going to go higher. It really is as simple as good news is good news and bad news is bad news. Just for my generalized conclusion for this week, again, as I've said here on this channel many times, I'm not concerned about the economic data for September. Really, until the election is over with, I don't think we're getting the most accurate data. I actually think earnings season is something we need to be watching a little more closely, like with FedEx's earnings. The data wouldn't tell you that, but FedEx is seeing a big slowdown. Are other companies seeing a slowdown? Are they going to give us similar warnings? That's what we really want to pay attention to, because everyone else can lie to you with no repercussions. Wall Street, corporate America, if they lie to you, they go to prison. So that's really what we want to be watching out for. In this upcoming week, we don't have much for earnings. You do have Tuesday pre-market, AutoZone. In after hours, you have KB Homes and Stitch Fix. Wednesday pre-market, Cintas. And after hours, Micron, Jeffries, and a couple of others. Thursday, Accenture, Inspire, CarMax, Jabil. That's about it. Thursday and after hours, you have Costco, BlackBerry, and Vail Resorts, as well as Scholastic. I think Costco could be interesting here. Seems like they're reporting quite early in the earnings season. And if they have negative things to say or do not impress on guidance, that one could be kind of an indicator of the economy, although I think Costco has its demographics. It's not usually super low income. So if you start to see the higher income slowing down, that's maybe what Costco could tell you. But back to what I was saying, markets are really just in a sugar high right now. And I don't think we have much to worry about for September. I think the sugar high of the 50 basis point cut and the bullish commentary we're going to get this week from Fed officials is going to be enough to probably push this market even higher. Because after all, I think the economic data is probably going to come in line with estimates, and that's going to be just fine for markets. Now, I do anticipate some kind of election correction coming perhaps in the second half of October, but from now until then, I don't really see a bearish case for markets. Wall Street has their soft landing narrative. They are continuing to support that in spite of the obvious signs of maybe not such a soft landing that is coming. And until there's something to really challenge Wall Street on that, which will come in the form of economic data, then I don't think Wall Street's going to change their mind for no reason. But Wall Street is trying to lighten up their exposure to stocks overall. On Friday, you had a market on close imbalance, which market on close imbalance comes in at the last 10 minutes of trading. You get the first report about 30 minutes before the end of the trading day. You can start to see the data coming in, but these are the orders that go through in the last 10 minutes or so of trading. And that's why right at 3:50 p.m. every day, you can see a pretty dramatic move in markets, and the final 5 minutes gets even more dramatic with more volume coming in, because these are the trades that are trying to get filled and, you know, get in or out of by the end of the trading day. Now, the imbalance shows you how much more there is versus the other side. So for the S&P 500, there was negative 5.3 billion. So 5.3 billion more sell orders than buy orders. NASDAQ 100 had negative 4.4 billion more sell orders than buy orders towards the last 10 minutes. The Dow 30 was negative 2.3 billion, and the Magnificent 7 was negative 5.1 billion. Even though these sound like ugly numbers, there is basically zero correlation between the market on close imbalance and stocks actually falling. In fact, what tends to happen is when you have a market on close imbalance of really bad numbers, you actually tend to see markets go higher on that. And let's be honest, in the grand scope of things, these numbers are very small in relation to the size of the general market. But it is a sign over time, if you continue to see this kind of activity, that Wall Street is trying to dial back their exposure to these different indexes and areas of the market. And apparently the change in the 12-month forward Fed funds rate signals a 100% probability of a recession, according to Goldman Sachs, which there is a bunch of other things listed here as well. The 10 and 2-year yield curve inversion. You do have US cyclical versus defensive PEs, which is here in orange, and the MBS spread. All of these tend to spike. But what's interesting about this is you tend to see this light blue line spike before the recession. So if you look at this graph as a whole, if this is a recessionary period, you did see the blue line spike before you actually went into the recession. It wasn't until you were in the recession that you actually seen the orange spike or the dark blue spike, right? That's when you tend to get a larger spike. And as I shared with you in the last video, Stifle Banner looks for the S&P 500 to experience a double-digit drop to the low 5,000s by the fourth quarter of 2024, saying markets could fall as low as 475, which would be quite a drop. In fact, if the markets fell to the 475 area, that would be a decline of about 16.5%. A drop to 5,000 on the SPX or 500 roughly on the SPY would be a drop of almost 12% from current prices. This is another interesting take here. It says, quote, "We believe the key difference between this easing cycle and past cycles is the profits trajectory. Historically, profits have almost always been decelerating as the Fed first cut rates, but that's not the case today." Bank of America Savita just said. But when you look at the profit trajectory, yes, it has been good over the past 2 years or so, but the expectation is an 18% EPS growth rate in 2025. That's not going to happen. It's not. Those are way too high of expectations. And the number could actually be much lower than that. Much, much lower than that. Just judging how weak the economy is today. Now, yes, the economy is not weak as far as government numbers. If you're on Wall Street and you have Wall Street buddies, then the economy is not weak to you. But if you're on Main Street with average people, the economy is certainly weak. And even for Q3 2024, the estimated year-over-year earnings growth rate for the S&P 500 is only 4.9%. So we're expecting that's going to rise to 18% by the end of 2025, basically year-over-year EPS growth rate. I don't see that happening. And that's one of the disconnects that I do see in markets today, with expectations being sky high for corporate America and for earnings, when in all reality, you're probably going to get a fraction of that. Now, at this point, the biggest thing the markets are going to pay attention to is, unfortunately, not earnings itself, but economic data. And I do think the markets are on a bit of a sugar high in the near term, and I'm not concerned about the economic data for the month of September. So I do think stocks can actually make their way higher throughout the month of September until we get some kind of election correction. And then after the election, we likely start to get more accurate economic data that reflects the weakening in the actual economy. So November, December, January, February, March of 2025, this is the area that I'm really concerned about, where the data might become more accurate. We might start to see the slowdown and GDP that could rapidly decline. Because even back in 2007, when the Fed cut rates 50 basis points, GDP was growing faster than it is today. But we still went into a recession by December. So you've seen a fall off a cliff. Now, even if we don't fall off a cliff, I think we've been falling off the cliff for the last couple of months, and the economic data is just not picking that up. So, in other words, by the time it starts to pick it up after the election for one reason or another, it might look like we just fell off a cliff. Even though I don't think the economy did fall off a cliff, it's been falling off the cliff. Just the lag in economic data will make it look like we're falling off of a cliff. I mean, hopefully that makes some sense to you. This is something I have been tracking with models in real time for the last couple of months, using different barometers of the economy, and specifically as well, some things that I have been seeing, some business owners that I have been talking to. I have a lot of business friends and a lot of business contacts here in Michigan, that is, and extrapolating what I'm seeing to the rest of America, it doesn't look good. So again, just to put all of this out here, I do think the rest of September is probably going to be pretty strong. I wouldn't even be surprised if the first half of October is pretty strong as well for markets. And then you get some kind of election correction in the second half of October. You get the election that comes, and then the economic data starts to weaken. Now, if the economic data does not start to weaken by then you could see a pretty aggressive, rally, I guess, after the election. Historically, that's what happens after you go through a correction. So let's say we have a 10% correction, and then the election comes, we get the results, then you could likely rally back to roughly the same levels that we are at. But it could be a pretty fast upside move. And then judging off of the economic data over the next couple of months following that, November, December, January, February, March, that is really what is going to dictate where markets go next. And unfortunately, I think there's a lot more risks to the downside in this market than risks to the upside. And yes, there can be upside risks. Like, what are the odds that you miss out on upside? Well, right now, probably not that high. There's probably not high odds that you miss out on upside. Back in 2022, when stocks had fallen a lot, there was more upside risk than downside risk, especially, when markets bottomed in September, October because of 2022, because you had already fallen a lot, expectations were very low, and you were expecting a recession, right? There was a 100% chance of a recession during this period in time. The upside risk was way stronger than the downside risk, so stocks rallied. Eventually, markets will come to reality and they will say, oof, the downside risk is a lot greater than the upside risk. There's not a lot of, incentive to be in markets at all-time highs, especially as that earnings growth rate really starts to disappoint in 2025. Because no way in hell are we going to have 18% year-over-year growth for 2025. I'll just tell you that now. So with that said, let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.